Hi everyone, welcome to today's webinar brought to you by Trintech. My name is Kelly Shevlin and I'll be your host for today. The title of today's webinar is Financial Close Fatigue, Learn How to Do More with Less. Before we get started, there are a couple pieces of housekeeping I'd like to go over. Firstly, please note that the lines are on mute to cut down on any background noise. However, you can send through any questions or comments as we go along through the webinar today through the chat or Q&A functionalities on the right-hand side of your screen. In addition, we are recording today's webinar session and we will send out an email after the event with a copy of the recording in case you'd like to view it again later. And with that, I'd like to introduce our speaker for today, David Woodall from Trintech, who will take us through today's presentation. David, I'll turn it over to you.
Thank you, Kelly, and welcome to this session. I'm David Woodall, and as an accountant with several years in various finance roles in a range of industry, my last role was in the R2R GPO team at GSK, where I helped design and deployed some best practices to help overcome some of those operational challenges with the close, and so very familiar with the topic for today. So let's get started and see how we can help with simplifying the monthly close. In today's session, we will look at the current macroeconomic challenges organizations are facing and how those internal and external challenges are forcing organizations to do more with less. From there, we will discuss why you should be leveraging financial close automation to overcome those challenges and better empower your teams. Lastly, we will conclude today's presentation with some best-in-class examples and ROI companies are achieving from adopting automation across their close process, and next steps your organization can take to achieve the same results. At Trintech, we know the pressures that your finance operation faces, and these can be categorized into the following three key areas. Fundamental to our operation is managing risk within finance and supporting the overall enterprise risk. It's finance responsibility to manage those financial operational risks to protect your shareholders' value. A robust control framework gives your shareholders, auditors, and leadership teams confidence that you're running a tight ship. In addition to managing risk, your business is likely to be in a constant status of flux and change, and good data is key to making an effective business decision. That data needs to be first time right and in a timely manner so it can enable your business to grow. The final category is how to unlock the potential of your teams to enable them to drive value within your organization. Finding ways to attract and retain your teams, keep them motivated, and building a career path that will help them keep them engaged for the future. We are seeing globally an increasing number of headwinds that have us now almost on a daily basis having to consider the impacts and look to change course based on the data. For US-based companies, a stronger dollar is creating headwinds on top-line revenues with the revaluation of income from entities outside of the US. Supply chain challenges still exist post the pandemic and now rising energy costs that have been caused due to the war in Ukraine. The rising costs of goods and services, partially driven by pandemic supply chain disruption, reached record highs in Q1 2022. Underscored by escalating geopolitical tensions, global inflation is expected to continue for the remainder of this year. In fact, a survey conducted by McKinsey at the close of the first quarter, the number of respondents citing the pandemic as a top risk fell from 57 to 12%, as much larger percentages now view energy prices and inflation as threats to the global economy. Inflation is impacting costs as governments and banks use fiscal and monetary measures to help control inflation. As inflation continues and drives wages up with it, economists predict little relief for industrial supply chains to help cool things off. Policymakers had originally hoped that as the pandemic risks decrease, household spending patterns would shift. However, even as employers struggle to attract and retain talent during a national labour shortage, hikes in competitive wages may not be pacing with inflation rates. So with inflation, interest rates and high energy costs, then it is fair to say that consumer confidence is low as we head into the winter period, and therefore a challenging period ahead of us. We can see that we have some significant challenges and a high degree of uncertainty managed over the next 18 to 24 months. Recent vacancy figures from the US and the UK still suggest that there are still a significant number of open vacancies, so there will be competition in the marketplace for those finance professionals. However, some organizations will now be looking at possible staff reduction as a reaction to the potential recession. The last time we faced this level of uncertainty was in the 2008-2009 financial crisis. The direct impact of that crisis was the need to reduce costs within the organization, and that resulted in finance having to reduce their headcount. We still had to deliver, so had to work harder with less people. We can see the dip in vacancies in that period, but if we now compare the vacancies today, then the number of vacancies is significantly higher today than in that period. So any easing due to release of heads is still unlikely to help smooth the current situation. So in conclusion, it would appear that whatever commercial situation my organization is, whether that's growth, stabilization, or recession, or will be in the next 18 to 24 months, then it would seem that my finance operation needs to develop a strategy to deliver those key financial initiatives by utilizing technology to offset either operating with a reduced headcount or to enable attracting and retaining talent. So in this prolonged period of volatility, we are entering a new economic environment. The old ways of doing things do not work today. CFOs and finance executives have had to be more agile than ever before. Investment in digital transformation has been a top priority for CFOs throughout the pandemic, as many kept digital investments safe from cost cuts, reallocating resources and even accelerating some investments. In fact, according to the same PwC survey, 56% of CFOs said that tech investments would make their company better in the long run. In addition, a recent survey by Gartner stated 94% of respondents reported the need to maintain or accelerate the already intense pace of transformation incited by the pandemic. CFOs' bets are paying off as their investments help make their companies more agile and able to handle the huge shift to remote and hybrid work. The success CFOs have seen is giving them a higher degree of confidence in continuing to get the technology angle right as their companies more fully embrace a hybrid work model, which the majority of CFOs say is part of their company's plan in the near future. Still, CFOs want to transform even faster. 68% are investing in digital transformation over the next 12 months. This is a continuation of what CFOs have been doing over the past 2 years to accelerate revenue growth. CFOs also see technology as far less of a barrier to making hybrid work successful than many of their peers. 44% say technology isn't a challenge versus 26% of all respondents. This is key to facilitating new ways of working. More than 2/3 are also investing in cybersecurity tools and training. As companies make the move to a hybrid work environment, cybersecurity remains a top concern, and more than 1/3 of CFOs say not having effective cybersecurity measures in place is a challenge to a successful hybrid model.